Peace and love, good people. Peace and love. Welcome back to the Universal Growth Network's Money Channel. I am your host, Stock Market Daddy. Let's get right into the education. A basic introduction to historical volatility and implied volatility by Webull Learn. All right, I need to know the name because some of these writers are really good, and then some of them are really generic, and I think Webull is taking credit for all of them. That's how you do talent acquisition, so they got it going on in that department. But some of this stuff is real poetry. So let's see who we got here. All right, suppose stock A and stock B are currently trading at the same price of $100. Why might their calls with the same strike and expiration be priced at different premiums? The answer may be found in the volatility of the underlying stock. Historical volatility of a stock. Now, volatility measures the amount of fluctuation or price movement in a stock over a given period. Self-explanatory. A higher volatility means a stock's price tends to fluctuate much more over time. A lower volatility means that a stock's price tends to be more stable. The hypothetical case in the chart below shows the two stocks' historical price over 12 months. All right, so we got stock A is the black line going right across the middle. Stock B is the blue line spiking up and down on the chart. Even though they both start at $100 and end at $100, stock B is more volatile than stock A, with significantly more fluctuation in its price over that time. So let me tell y'all something real quick, something I noticed, especially with stocks like Tesla. And this is why reading the charts can really change your game and really enhance your decision making, and potentially increase your win rate if you pay attention to the patterns. So a stock like Tesla, I noticed that it might run $7 to $10 a day. I mean, it's opening at 320 going to 330, then opening at 330 and coming down to 321, and then sometimes it's $20 and $17. But if you look week to week, it might be moving up and down $1, up and down 50 cents. So from Monday to Monday, you might only have $1 move total, but it has went $7 and $10 a day. Then you get another stock like American Airlines that might, move $1 over the week, but it was only moving 50 cents a day, and then it landed at $1 in a week. So the volatility matters. More back to it. In practice, traders can use historical volatility, HV, to measure how much the stock price is deviating from its average, often expressed as a percentage of the standard deviation of daily returns. If anybody ever took a statistics course in high school, standard deviation is a term we should all be familiar with. All right, let's not act like the school system ain't teach us nothing. I hate when people do that. I hate that. Y'all learn stuff. Y'all just learned it out of context, and we got to put it back in order so we can keep growing. HV does not indicate the direction of a stock's movement, as volatility increases with drastic price swings up or down. Historical volatility is a backward-looking measure, i.e. historical. All right. It reflects the volatility of a security's price in the past. As a result, it may not necessarily be a reliable indicator of future price movements. All right. More like a pattern recognizer than a future predictor. Implied volatility on each options contract. Now, this is a little bit different. Unlike historical volatility, which is calculated from past price changes in the underlying stock, implied volatility, IV, is a derivative. All right, it's derived by starting with the current market price of a stock or option and putting it through the chosen price model backward. There are a number of methods and models you can use to calculate the implied volatility of an option, including the Black-Scholes model. These models use the current market price of the option as well as certain assumptions about the underlying security, such as its current price, the risk-free interest rate, and the time remaining until the option's expiration date to derive its implied volatility. All right. There are a number of methods and models, all right, to get you to what the implied volatility is. All right. So I'm looking at this: strike price, current stock price, risk-free interest rates, time to expiration, options market price, inputs, outputs. Okay. For example, suppose there is an increasing demand for ABC call options in the marketplace. Bidding up ABC call options prices. All right, let's wrap our minds around this. Okay, so for example, suppose there is an increasing demand for ABC call options. Let's say Apple. So there's an increasing demand for Apple call options. All right, so everybody is buying up Apple call options in the marketplace, making the bid price, making the ask price of this options go up. All else being equal, the rising premium will lead to the higher implied volatility of the call options contract. All else being equal, the rising premium will lead to the higher implied volatility. So as people start to buy this Apple call option, the premium, the cost of this option is going to increase. That's why they call it demand. So if only one person wants it, I'll give it to you for $15. All right. But if 1,000 people want it, oh, it's $30. Yeah, $30. Okay. So that's what we're saying. All right. As the demand increases, the cost of the option is going to increase. And this is going to lead to higher volatility, bigger price swings. All right. For the whole week, we only got a few people looking at it, looking at American Airlines options. Yeah. That thing only going to be moving 50 cents to $1 all week. Oh, but Tesla? Oh, you talking about people love Trump, hate Elon. Oh, he fighting on the main stage. Oh, we going up. Well, we buying it, selling it, buying it, selling it. It's an emotional stock. All right. It's emotional. Everybody is in it. Different emotions is volatile. That's what it's going up and down and back and forth, just all over the place. It's emotional. It's not stable. It's not secure. We don't know what's going to happen next. So it's volatile. And now I get it. Because the price of the option contract is a function of supply and demand, IV is assumed to represent the market's consensus on the future volatility of the underlying asset over the option's life. Okay, so on the options chain page, you can check the real-time implied volatility data for every option on an underlying contract. So you see the picture, and they're giving you an example of that percentage. That 26.42% is the implied volatility. Let's keep going to keep growing. Implied volatility on a specific symbol. Every contract has its own implied volatility, even different contracts on the same underlying symbol. The factors that influence option prices are weighed differently between different strikes and expirations, IV among them. All right. Some traders refer to formulas and calculations designed to approximate an overarching IV for all options on a given symbol. Although this can be difficult to achieve and incorporate subjective value judgments. Okay, hold on. So some traders refer to formulas and calculations designed to approximate an overarching IV for all options on a given symbol. All right, so I guess there's some formulas that you can use that assume that you're going to get an average IV for Apple, an average IV for Tesla. All right, although this can be difficult to achieve, and in order to get that, you got to have some subjective value judgment. So I guess this paragraph is saying that those formulations and calculations are a little shaky, but people use them nonetheless. One way of calculating such an overarching IV is by weighing the individual IV value against other criteria. Some assign, see, look, this writer right here is real specific with his words or her words. All right, they're not overgeneralizing. So some assign greater weight to the volume of options traded or to open interest, while others give the greatest weight to the at the money options, as is most common. Okay, so when you're looking at the IV, when you're trying to look at these formulas for IV, some are looking at the number of options traded. So the number of the supply and demand as a measure of the value of an option. Other people are looking at open interest, like how many people already are in it. All right, the open interest, how many people are already in it. The volume is like how many people got in it today. Right? And then other people give a greater weight to where the stock is in relation to the strike price. And that's the most common approach. A consistent IV metric can help you to make informed investment decisions. For example, when the implied volatility of a security is relatively high, it generally indicates that the market expects the stock price to be volatile. Whether you agree with the market sentiment or not, you may want to adjust your investment strategy accordingly. The knowledge about market attitudes provided by IV can help you do just that. The implied volatility of a symbol changes over time depending on market conditions and other factors. It's important to regularly check the IV, the implied volatility of a stock, as it is with any indicator you use to craft your trading strategy and make any necessary adjustment to your plans. The bottom line, both historical volatility and implied volatility can be useful indicators for investors and traders. Historical volatility, a backward-looking indicator, can help you understand how the security has behaved in the past, providing helpful context to gauge the regularity of current trends. On the other hand, implied volatility is a forward-looking measure that can help you gauge market sentiment and assess the potential risk of a stock option. Peace and love, and I hope you get rich. Please subscribe to the channel. We got 70% of viewers not subscribed. Ridiculous. All right, let's get it together. Let's keep going to keep growing. I'll see you in the next video. I hope this was helpful, and more importantly, I hope you get rich.